Let's actually put this to Rajesh Kothari, who's with us. He's Managing Director at Alpha Accurate Advisors. Rajesh, good to have you with us here. I just wanted your thoughts on Zomato, as we were sort of discussing. Do you like it? Do you have a view here? Rajesh, I think you are on mute.
Sorry for that. So basically, difficult to give stock-specific views, but what I can say is that in general, all the digital platform companies, thanks to the very harsh winter on the new age businesses globally and in India, the choice of promoters, the entrepreneurs, to focus on profitability over revenue, that has become a natural, obvious choice for them. The business mode was always there, but just to gain market share while burning money, that was a problem when you are an unlisted company. And when you become a listed entity, everybody starts focusing on how much money you are making and ultimately ROE. Now, because of the harsh winter on the private equity side, I think most of the listed companies on the digital platform side of the verticals, they have started focusing on profitability. They became more rational. And at the same time, because of the unavailability of the new funding, the new entrants are not able to enter with that, sharp pricing or the discounting or to burn money kind of an, aspiration. And that results into all of a sudden significant improvement in profitability, be it a food delivery business, or be it an insurance-related technology business, or be it a payment-related technology business. So I think all these companies are going to do well. They have a definitely good moat what they enjoy in their business. And the only risk I always say, the disruption can be also disrupted. So technology remains the biggest risk. If somebody comes out with something a little better, something a little different, and something more efficient, then that becomes a real threat. So we need to keep monitoring how this business profitabilities are improving and how they can also improve the scale along with the margins. So that's basically the tracking points from our perspective.
But Rajesh, does this all translate into buying any of the new age tech companies? Are they a part of your portfolio?
Yeah, we do own, if you look at our portfolio, we do own, a few names in this, good digital businesses, and they've been quite rewarding for us.
All right. Hi, Rajesh. You've always told us you'll move things around and you'll look to optimize profits, and your returns as well have actually been quite good over the last few years. So good on you and good on your investors as well. Give us a couple of those stocks where you'll have either increased weightage or reduced, or maybe you'll have added something fresh in your portfolio. Give us a couple of names.
Unfortunately, due to regulations now, difficult to put the names, but I can tell you that what we are, becoming more positive on. So auto ancillary is one space where we are adding the weightages. I think because of the change in technology from ICE to EV, your opportunity of the content per vehicle is going to become 2x, 3x compared to where are we today. And that gives a immense scope and potential for many good established auto ancillary companies to increase their revenue size because potential is 2x, 3x per vehicle. At the same time, because of their domain in their businesses, they are also adding the global customers in their client profile list. Now, combine of this can result into 25, 30, 40% kind of a compounded profit growth for many auto ancillary companies. So this is one space, incrementally, if you ask me, where we are becoming more positive. The second space is the NBFC space. We have discussed last time as well. And we continue to like that theme of non-banking finance companies. Many of these names are now at, I would say, 15, 18, 19, 20% kind of a ROE with a very strong 20 to 30% kind of a loan book growth. Now, this combination is a rare combination because on the bank side, most of them are growing at 12, 13%, or maybe profit 14, 15% with a good ROE ranging between 14 to 16%. But on NBFC side, now we are getting select NBFCs where ROEs are upwards of 18% plus, and profit growth, PPOP growth, loan book growth are also 15 to 20 to 25% plus. That's a very good combination, apart from, of course, the right credit cost. So that's NBFC space, which is the second one, which I would say, which we are incrementally getting positive.
What about Path Labs? Because we're hearing, voices from the management themselves that the competitive intensity, the extent of intense discounting is coming down. Stocks have been beaten down. So is Path Labs looking attractive to you?
Yeah, as I said, on the new age side of businesses, there are many guys that wanted to do discounting business, and definitely, that is reducing. But currently, we don't own, any of these names. As I speak with you, when we look at this space, we look at overall retail space, be it a pathology, be it a consumer, focused retail businesses, or be it a, electronics related retail businesses. And when you put that entire gamut of companies in the universe, from that universe, we select the companies on which we are more bullish on. So currently, these are the names which we currently do not own. We own more on the apparel side. We also own more on the electronic side when it comes to retail as a format.
Electronics Mart, that one, Rajesh?
I missed your voice.
Sorry, Electronics Mart, that is the company you're talking about, or?
I would not like to comment on the names,
but got it.
But there are only few listed companies within the electronic space, on the retail space, and those are the names which we are basically evaluating or might be holding in our portfolio.
Rajesh, what to avoid? What to avoid, Rajesh?
I think first very important thing, avoid just pure momentum. Number one. Number two, avoid companies where profit size and ROE and debt equity are not healthy. Because right now I can see many stocks which have gone up 2 times, 10 times, 20 times without underlying strong fundamentals. Because of course market has been very strong, but that may not continue for long. And once that comes down, it leads to significant permanent loss of capital. So what I would say only appeal to the viewers is, please make sure that don't lose your capital on permanent basis. There are many things to avoid from the stock specific perspective.
Rajesh, this dire, so Titan just reported numbers, right? But look at, Senco, it's I think locked up, it's been locked up for a while. It's at a new high, done very well. Thangamayil reported numbers recently. There was a bit of a disappointment. The market didn't like the numbers, but it's done very, very well. Do you like this space? Again, organized retail in the jewelry side?
Of course, we own one of the name what you mentioned, Titan, from last a few years. We continue to currently own. Please put a disclaimer: we own this company for our portfolio clients, and we remain extremely bullish, on this space. I think entire space is going to do well. But one important thing when you look at this space is the corporate governance, because as a business store, you are also dealing in cash. And that's where the governance is something very important in retail business in particular, and more importantly for gold and jewelry business, because it is a large ticket items. So we are more comfortable, extremely comfortable, of course, with the select names. And despite their size and despite their market leadership, they continue to outgrow the industry, and they continue to do extremely well. So, of course, it has been very rewarding for us.
You spoke about avoiding momentum stocks. Now, over the past few months, we've seen momentum in PSU banks, we've seen momentum in defense, railways, EMS companies. Any of these pockets which have done very well, where you think the fundamentals don't align with the kind of up move that we've seen?
I think when it comes to avoiding the things, it becomes more stock specific rather than generalizing the things. Like, for example, PSU banks, they are really good banks, but few names, be it PSU or be it private, irrespective of the sector, irrespective of owner, irrespective of global or local, there are names which have gone up without underlying fundamentals. So I'm saying more from that perspective. PSU bank in general, no problem. We also own PSU banks. EMS companies, we also own. But I have seen few companies, their names have changed and they have all of a sudden become EMS. They claim themselves as the EMS. And those stocks are up 10x in last 5-6 months. So I would say avoid such kind of things.
All right, Rajesh, good speaking to you. Thanks so much for joining, and we're hopeful to chat with you on more stock-related names maybe the next time around. So if that's possible, will be great. Wishing you a good weekend and festivities in case we don't speak before that. Well, look, Escorts, Kubota, those numbers